Facebook's shares have tumbled more than 20% in after-hours trade on Wednesday as the company reported weaker than expected earnings. The company also issued disappointing guidance for the first quarter. Daily active users were slightly down in the fourth quarter compared to the previous 3 months, marking its first quarterly decline in users on record. Facebook said revenue in the first quarter will be between $27 and $29 billion, while analysts were expecting sales of $30.15 billion, according to Refinitiv. The company is being hit by a combination of factors, including privacy changes to Apple's iOS, macroeconomic challenges, inflation, and supply chain issues that are impacting advertisers' budgets. The report is Facebook's first since changing the name of its parent company to Meta. For more on this, now joining us is Victoria Sculler, Head of Investments at Interactive Investor in London. Many thanks for being with us today. Victoria, so what is the impact, first of all, of this privacy changes to Apple's iOS? I mean, what do they mean? And what is the quantifiable loss for Facebook?
Hey there. Yeah, so of course, this is one of the big parts that came out of the earnings report last night. And Facebook says that this will lead to a $10 billion hit to revenue this year. So it is a considerable amount. Essentially, this is Apple's app tracking transparency feature, with Apple bringing about these privacy changes last year. And it's created a big headwind for the social media giant. But like you say, that's just one part of the puzzle and why the stock sold off so heavily, shedding nearly a quarter of its value after hours. It was also about the inflationary environment, supply chain issues as well in terms of the macro headwind. And of course, there is that broad rising rate environment that spooked stocks in the first month of the year. And there's the daunting prospect of the potential for single-digit revenue as softer monetization and revenue and engagement could see investors flee the stock even further.
Interesting, Victoria, because you rightly speak about the macro environment, but I mean, we've seen Facebook, Spotify and PayPal, 3 very different companies, all showing signs of fatigue at the moment. I mean, what's happening? Are investors really having a reality check on their business models? And what I mean to say, I mean, it's really hard to blame the Fed for everything right now. What's happening?
Yeah, I think what we've learned from the price action last night, particularly from Meta and Spotify, is that there's a real sense of unease in the market. We've seen above average moves in terms of stock prices after that big sell-off in January. And it feels like investors are really on the edge of their seats. And the big question is whether tech can continue to rally within this rate hiking cycle. But you're right, it's not just about the Fed, it's about their business models too. For Facebook, competition for eyeballs is intensifying, and we've seen it switch towards products which are harder to monetize, such as Reels. That's where the real demand is. And then for Spotify, it's also still reeling from the Joe Rogan podcast controversy as the streaming giant looks to navigate this shift as it's positioned from exclusively a streamer into being a content creator as well. So while that creates opportunities, it also creates challenges. And then, of course, a lot of these stocks have done very, very well during the pandemic, with a lot of us glued to our phones at home during COVID. Now things are going back to normal. Perhaps that competition for eyeball intensifies further.
Interesting analysis. Victoria Sculler, thanks for being with us today.